Yeah, we appreciate it, Mark. We're grateful to have him join us. Mark's the Director of Investment Strategy and Education at BlackRock. I believe I have that correct. He's been in the business for about 20 years, and he educates professionals on equities, fixed income, alternatives, multi-sector approaches to investing. So pretty much the whole gamut there. And as Cami mentioned, he's going to speak to us about the student of the market presentation, share some slides with us, hopefully. And Mark, welcome to our call. It's typically, it's about 20 to 25 minutes of presentation. And then we'll ask you some really difficult questions at the end.
Great, thanks. Good afternoon, everybody. Thanks for having me on your call. To talk a little bit about the election. We're in full election season here with a month to go, or less than a month to go. So I don't know if I can share some slides here. It's saying the host is disabled participant sharing. So I don't know if we can alter that. But clearly, you know, in my 25+ year career, I've never had so many requests for information around one specific event. And the election certainly is that event. Clearly that's what we try to do with our student of the market piece. This is something we do monthly, actually, that is end client approved. So it's trying to give you some ammo to talk with folks across the country. So let me see if I can share my slides yet here. There we go. Thank you. And so we'll just hop right in and talk about what we're seeing right now. We'll talk about a handful of things along with the election. So we'll kind of weave in the last couple months of student of the market. Here's our volatility gauge, which is 2% trading days for the S&P 500. So just how many days the S&P 500 moves up or down by 2% or more. And you can see we're at 42 days so far this year, which is on pace for 56 for the year. Which would put us right in that ballpark of what we saw in the financial crisis, especially in 2009. Granted, this pace has slowed quite a bit over the last handful of months here. As you can imagine, we were on a pace for over 90 at one point earlier this year. But we like to talk about 2% days. I think folks understand that a little bit more than a volatility index or something like that I certainly can't explain in less than 10 minutes. So. Plus or minus 2% days, and you can see the historical context here with previous years. As far as the election, last couple of months of the year, you know, we pulled out a lot of information, tried to be as nonpartisan as possible, just looking at different data. And here's the last couple months of the year, what it normally looks like in an election year. Normally October is a little bit lower in election years. You can see this goes back to 1926, just looking at monthly returns. And of course, October is not a great month traditionally for the stock market. Actually, September is the worst. October is second worst. And you can see in election year, October is actually slightly negative, which is was a little surprising that you do see a little bit of that volatility pop up in October. November and December snap right back though to longer term historical norms. So certainly that's a little bit reassuring. Of course. Contested election, that's going to pop up, and I'm sure that's everybody's talking about that a little bit, right? That possibility that we just don't know that next Wednesday. And the nice thing here, I don't know if it's a nice thing, but it's a something that we did have a contested election back in 2000, of course, the Bush-Gore election back at that point. You can see what the stock market did over that period of time. And of course, the challenge here was we were having a tech bubble bursting at this point. So there was a lot of negative momentum in the stock market at this point in time. You can see the market was actually down 1.6% heading into that election. During that contested period, which if you recall was a little bit over a month, and what is that, 5 days? Month and 5 days, the market was down another 4.9%. So that's in addition to being down 1.6, it was down another 4.9% during that month plus period. You can see we had 4 plus or minus 2% trading days. So we did have a little bit of spike of volatility, a little bit of added downward pressure on the market during that contested period, but it wasn't tremendous or anything that was unprecedented. right? And you see 1 month later, we were down another 3%. So hard to disconnect what was the contested election here, what was the tech bubble bursting. Clearly, there was negative momentum heading in and following the contested period, maybe a slight uptick in volatility, but certainly nothing unprecedented. I think that was just reflecting, right, what we see in a lot of the election data, which is that the long-term trend holds, right? We get emotional about the elections. We like to think all the policy is really a huge issue, but the longer-term trends really seem to take over. And I think you saw that during this contested election period is that caused a little bit of volatility, but it was still, right, we were still dealing with the hangover from the tech bubble. And of course, here's the long-term chart when you look at who's in office during which point in time. This goes back to 1926. And you can see if you had $1,000 back in 1926, the old Ibbotson chart, you can see it's grown to almost $10 million at the end of September, so not too shabby. Wish we all had 94 years to invest, or almost 95 years now to invest. But for us, this really speaks volumes of what we saw when we looked at the data historically on elections, right? It's the old Mark Twain, history doesn't repeat, but it often rhymes. And what was clear here is the market is tremendously resilient over time, regardless of who's in office, right? We've all seen charts like this where you can overlay all the world events. Think of all the world wars, right? The Depression, all the recessions over this stretch, yet the market's gone higher, right? Think of all the different presidents, the administrations, resignations, assassinations, and the market's gone higher. That's really shines through when you look at the election data and the market, is just how resilient the stock market's been over this long stretch, regardless of who's in office, right? We get emotional about the election. This one certainly is as partisan, as divided as we've been. But, I'll just point out a couple periods. If you can see my cursor here, look at this tech bubble bursting that we touched on earlier. That was certainly a handoff from blue to red there. But think about that period of time had nothing to do with who was in office at that point in time, right? I think that was the tech bubble bursting at that point in time. Certainly was not Clinton's fault. It wasn't Bush's fault when he took over, right? And then you pile on 9/11 and a recession on top of that that came after that. And I think that really speaks to what we see consistently through the years, is that the elections and policy tend to be very short-term issues, right? They tend not to be the long-term drivers of the direction of the market and the economy, right? The way society changes, right? Think about that tech bubble. It was all about us embracing technology like never before, right? We all got introduced to the internet, right? Some more than others at that point, but that had nothing to do with who was in office or who was in office after that. I think we see that throughout time. Is the amazing resiliency of stocks, right? Think of those stocks that make up the index today, right? Apple certainly is going to sell a lot of iPhones, regardless of who wins in November. And I think that's really the lesson that we drew from all the election data that we looked at. I think a lot of the studies will, say, oh, this party's better, that party's better. You really have to massage the data to really get it to bend that way. And I think the other reality here is you see, look how few times we've had a shift in parties, right? You're talking about 6 Republican streaks here and 5 Democratic streaks. Granted, some of the streaks lasted a long period of time, but right, the shifts in power, I think, are interesting. And again, did not really seem to have any big driver on the direction of the market, which I think is certainly a testament to our system and the exchange of power over the years. But for us, this is one of the big pictures that we took away, big elements of looking at election data, is just how resilient the market's been. Here's a little bit more detail on the stats. You can see over that, almost 95-year stretch, to get $1,000 to grow to almost 10 million, you've got to do 10.2% per year and compound that out. Presidential election years underneath that, we just stripped out every 4 years. I guess the first one would have been in 1928 over that stretch. You can see Election years have actually averaged a little bit more, 11.3%. Midterm elections, a little bit less, 8.6. Non-election years, odd years, a little bit better, 14.3. So again, nothing, I don't think too dramatic here, right? Everything kind of bouncing around that average, everything trending towards that average, a little bit above, a little bit below. One thing that is very clear in the data is that investors tend to go to the sidelines in these election years, right? We went back and just looked at money market flows. So flows into money funds in these election years, you can see you normally get twice the amount of flows into money funds. So those cash on the sideline accounts that are paying little to nothing, normally you get about 114 billion going into those money funds in election years. Non-presidential election years, it's only 56. So you can see in presidential election years, it's normal to have some caution for folks to not feel comfortable investing or putting money to work, or even potentially taking a portion of their portfolio and moving it to the sidelines, unless money goes into stock and bond funds, right? Just consistent with that theme, that there's a little caution normally in election years. And I think we could add it to the list of classic behavioral mistakes investors make, right? They just have too much caution in election years. And of course, this year's just amplified even more, right? It's obviously, you see the flows on the right this year. We've had 757 billion, almost $1 trillion go into money funds this year. And money's come out of stock and bond funds year to date. Obviously, that's more than just the election. It's the virus and the health concerns, the shutdown and the economic concerns. You know, certainly the market volatility back in March and the subsequent rebound we've seen since. And then you throw a very partisan divided election on top of it. It really is a perfect storm of challenges for investors. So this is certainly something we're talking to a lot of folks about, is just how challenging this year's been. I think we all know, right? We'll all look back and know how difficult it's been. But really, when you put that investor behavior hat on, it's really been a perfect storm of events that have created all kinds of challenges. And I think we need to recognize that folks have moved to the sidelines in front of this election in a bigger way than we've ever seen historically. And you see it in the assets. Here's the assets into money market funds. So this is dollars into money funds, and you can see that this September wasn't the peak. We're at about 4.4 trillion right now in money funds. If we looked at it, I think the peak was in May. We had 4.8 trillion back in May, but we just wanted to highlight some of the other peaks in assets. So this is assets. The previous chart was flows. You can see the other peaks were actually at the end of the other recessionary crisis periods, right, or bear market periods, right? January of 2009, we hit 3.8 trillion. That was the end of the financial crisis, right? Actually, the bottom was in early February of 2009. And then the previous was January of 2003, following that tech bubble bursting, right? I think the peak was actually September of 2002, or not the peak, but the bottom of that point was September of 2002. But we didn't have the peak in money fund assets till the end the end of January 2003. So, but you can see on the right just what stock returns did in 3-year periods following these peak in money on the sidelines, essentially, right? You can see next 3 years, stocks did 16.4% following that tech bubble peak, and then did 19% per year following the peak in the financial crisis. So clearly a very bullish sign to see all these dollars on the sidelines. Now, some of this is probably fiscal stimulus the government's put in. But clearly what we've seen historically is that this money eventually finds its way back into the market. And that's certainly something that we're all talking about here within BlackRock. Just record amounts on the sidelines. I think it certainly helps stocks so far rally back, right? We've just seen so many dollars on the sidelines. As it trickles back in, it certainly helps support prices going forward. Now, this is one of our favorites on the election. I think it really helps explain some of the stock market rally this year. This looks at the polls that look at satisfaction level on how what direction the country's going, right? Are they satisfied with how things are going here in the U.S.? This is actually the Gallup poll on the left side of the chart. that goes back to 1979 and just asks that question: are you satisfied with how things are going in the U.S.? And at the end of August, actually, we were down to 13%. One of my colleagues wondered who were those 13 people that were satisfied during a pandemic on how things are going. But 13%, it wasn't the all-time low, which is interesting. We were actually lower during the financial crisis. In December of 2008, we were down to 10%. You can see 92, a little bit of an outlier. And then you go back to July of 79, we were actually lower as well, down to 12% in July of 79, with double-digit interest rates, double-digit inflation at that point in time. And you can see what happens when we have put stock market returns to this level of satisfaction on the right. You can see we just drew the line in the sand and said, whenever less than a third of the country was satisfied, right? So less than 33% said they were satisfied with how things were going. Stock returns were actually better at 14.5% per year next 12 months. And then the opposite's true when more than half, more than 50% were satisfied. And the peak was back in February of 1999, 71% said that they were satisfied. It seems like 3 lifetimes ago that we had that kind of consensus in the country, right? You can see the stock returns over the next 12 months were only 7.3%. But think about this dynamic. I think this is incredibly telling, right? All the bad news gets built in to the market when everybody's dissatisfied, right? And the opposite's true as well. All the good news gets baked in when everybody's feeling very satisfied. And that's certainly reflecting in the stock market that we've seen since the March lows, right? Is that the stock market's a forward-looking entity, right? We built in all the bad news, or at least a good chunk of it, back in March in a very quick and extreme fashion. But the market naturally looks forward. And that's the disconnect I think clients sometimes, investors sometimes feel between what the market's doing and how they feel about the economy. So I thought this one was valuable. We've certainly used it for a while, certainly gets a good reaction. I think it really helps folks connect those dots on how can the economy feel so bad, yet the stock market do so well. Certainly this dynamic's been consistent over time. It's not just this period. Just a little bit on growth and value. I think obviously this is a big thing everybody's talking about, right? It's probably the longest growth cycle in history, and now it is the largest growth outperformance cycle in history. So you see the other 2 peaks. We've actually passed where we were in February of 2000, and then back in that Depression era growth cycle back in December of 39. So it's the largest outperformance of growth. We just looked at the value outperformance following those other 2 peaks, and clearly it was strong tilt back towards value at that point. Certainly impossible to call the turn here, but did want to highlight we did hit historic levels here back in August. Switching the gears a little bit to inflation and interest rates. This is 40-plus year periods, I guess 40 years on the left, and a little bit over 40 years on the right. And obviously the challenge we have today is that interest rates are historically low, right? We thought they were low before and they went a click lower. And you can see on the left that 40-year stretch from 1940 to the end of 1979. So right up to the period where we had double-digit interest rates and inflation. You can see the returns for various asset classes. And the challenge here, of course, was inflation outpaced bonds and cash, right? You actually had a negative real return in bonds and cash, not even adjusting for taxes on this slide, just purely on inflation versus bonds and cash in a rising interest rate environment, right? Long period of rising interest rates, but clearly a challenge for that conservative part of a portfolio versus the right side, which is a 40-year period from 1980 to the end of September. And you can see that both stocks, bonds, and cash all did well over that 40-year stretch, outpacing inflation, even as inflation's ticked down a little bit here. But clearly the concern moving forward, and something we're talking a lot about at BlackRock, is moving forward, even at low levels of inflation, right? If inflation's 1.5%, 2%, and interest rates are well below that, you might start to look something more like on the left side of this slide going forward. So just something to think about. Clearly another example of how the elections won't change things. This chart will not be affected by who wins in November, right? We're still going to be faced with historically low interest rates. And I think that challenge is going to be with us for quite some time. So a good example of just a long-term issue that has no impact on the election that really impacts investors and portfolios here going forward. A little bit more detail on interest rates. Here's the last 8+ years on the 10-year U.S. Treasury bond. We've been in very distinct environments where rates have either gone up or gone down, right? Not exactly in straight lines, but you can see the graph here on the left showing what rates have done on the 10-year. Pretty distinct environments here where rates have either gone up or gone down. And one thing that we certainly touch on a little bit is that you certainly need a well-diversified bond portfolio. But if in a rising interest rate world, you will see active outperform the core bond index. You can see it's a pretty healthy margin, especially in a low interest rate environment. If you outperform by 100 or 200 basis points, that's certainly significant. But of course, the bond index will do well if rates fall. And you see that during periods where rates fall, and that's obviously a period when stocks often struggle as well. So the entire period, the returns look pretty darn similar, but pretty distinct performance in various interest rate environments. You know, something we talk a lot about at BlackRock, that maybe it's a good time to really barbell that bond portfolio. Certainly have some of that index for diversification purposes, especially with your stock portfolios, but balance it with the flexibility that an active manager might provide. That flexibility in a rising interest rate environment's really paid off. So why don't I stop there? I think I'm out of charts, believe it or not, but hopefully that was helpful. Think about right, everything that we touched on there. Really, just thinking about the election longer term really goes back to the resiliency of the market over time. Really undeniable over that long-term stretch. I think one thing that's clear is that investors tend to go to the sidelines in these election years in big ways. This year's obviously very amplified in that regard, given everything we've gone through the last seven or 8 months. So those are the two big takeaways for us on the election, is that it's emotional. We're all challenged with it, but the longer-term resiliency of the market really shines through. And we really need to fight that natural emotion that might pull some investors to the sidelines or not put money to work. So why don't I stop there, see if there's any questions or any thoughts or any comments, anything you want me to fill the gaps in on.
I had a question, Mark. Do you guys do any work on deficits? And you know, when a deficit becomes a certain part of the GDP, when does that become detrimental to the stock market or become a concern?
Mark, we can't hear
Hey,
you.
Mark, we lost your
Yeah,
audio.
I can't hear you, Mark. Sorry, we didn't hear any of it.
Sorry about that.
Thought it was me.
You figure I'd have figured out how to work the mute button by now, but
All good.
you know, there's been a lot of work done on that, and really no conclusion there, right? Because you could have said at different points in time now that the debt relative to GDP is way too high, yet it hasn't impacted the market or interest rates, right? So there doesn't seem to be any conclusion at this point, right? It's the old classic. It's not a problem till it is, and I think that's certainly the challenge that we see, is that it's grown to a tremendous extent this year. Nobody seems to be talking about it. The only thing they seem to agree on is more spending, right? Whether it's another million or another trillion or 2 trillion, right, is what they're fighting over. It's the size of the check, not the check itself. So clearly that's a concern. And at some point we'll have to get that under control, right, and do what they both hate, right? We'll have to cut the size of government and raise taxes, right? It probably won't be a one-way issue. Obviously, keeping interest rates low and everything the central banks are doing across the globe is helping that in the near term, right? And it's probably a trap, right? You pay very low levels of interest rate on your debt. That certainly makes it less of a problem. But think about what the debt financing would look like if rates went back up to 3 or 4%, right? And wouldn't take very many years for that to really create a tremendously large budget item just to pay down the enormous size of the debt at that point. So certainly something to be concerned about. A little concerning that nobody talks about it anymore, but it's certainly on our radar at this point.
How about, sorry, go ahead. Go ahead.
No, go ahead, Tom. You can keep going. I'll ask him after.
Okay. Well, I was going to ask about I think that chart you showed about the, Democrats versus Republican was pretty much the executive branch. But how about if there's a sweep where you'd have potentially a Democratic sweep? Would that influence that chart at all? In terms of legislation?
We looked at I think the divided government is one thought that a lot of folks have. You'll see some things that folks will say a divided government, right? So one party not controlling the House, the Senate, and the presidency is a good thing, right? It's a good thing for the market if it's a divided government because you don't get a big swing in policy, right? You need all three to really get something drastic done. And you could certainly intuitively make some sense that you don't want dramatic shifts in policy every 4 years or even every 8 years, right? Think about healthcare and tax policy and all those other things, right? You just can't have dramatic swings every 4 years. So the thought is that that's good for the market, a divided government, having some gridlock. I couldn't find it in the data. Honestly, you have to do some massaging in the data to make it work. I mean, the numbers were almost exactly on top of each other, looking at a divided government versus non-divided government. I think you could probably massage the data, but again, you start to really get small data sizes, right? It might seem like a 90-year period is a long period of time, but when you start carving out, okay, here's when the Republicans held the presidency and the Senate, right, but not the House, right? You start to get a really small sample size at that point. So I just think a lot of that data is pretty inconclusive, and folks, if they're showing you that data, they're usually trying to do it for a partisan reason.
I had some questions about the last few slides that you showed, actually. If we could bring up the satisfaction slide again, that would be helpful.
I probably shouldn't have pulled those down there. That probably wasn't.
Well, so my question is, maybe I feel like we're in a unique circumstance right now, and that it looked like we're almost at all-time lows from a satisfaction perspective. Yeah, we're at an all-time low pretty much from a satisfaction perspective, but we're also really, really close to all-time highs on the stock market. So I'm just kind of curious, how often we've seen that, because that could be kind of somewhat of a unique circumstance. I mean, it looks like December 2008. I know we weren't all the way at the bottom there when satisfaction was really low, but we were damn close. Other periods of time I'm not entirely sure about, but could you add any color there?
Yeah, no, it's a good point, right? This cycle is a little bit different, right? That we're a little ahead of the ball game here. We actually did tick up to 14% in September, so a big move in September up to 14% satisfied. But clearly a little bit unique to this period, I think, is different than other recessionary periods, right? This one is probably going to be a lot shorter, hopefully. And also the fact that everything the government's been able to do from a stimulus, everything the Federal Reserve is doing is a little bit different than previous cycles, right? I think always past recessions, we're always chasing it, right? We're always chasing it. This one, we were actually able to get in front of it and provide stimulus, right? Provide some of the spending, unemployment benefits, Federal Reserve stepping up with liquidity in a major way. So I think just the size of all that intervention has helped the market bounce back sooner than the previous periods. So, and obviously some of this is the virus and maybe a little bit of the election as well here, causing that number on the left to be a little bit lower. But I think for us, when we talk about it at BlackRock, it's just the unprecedented nature of the shutdown itself, right? It's just not your typical recession. It's not your normal business cycle, right? It's just so unusual that it was such a hard, fast shutdown. And then you had all the government policy and stimulus right in front of that, right? Or right on top of that as we shut down. So in past years, think about, right, a lot of the intervention in the financial crisis, right? A lot of that didn't happen till late stages 2008, even as the financial crisis started to unfold in 2007, right? It took a year to really try to get some of the stimulus in place to bridge that gap, and a lot of the damage was done at that point. So I think that's a little bit of the disconnect you feel.
Okay. Yeah, because I mean, just thinking about it right now, we're damn near as low as this chart gets, and the chart on the right is saying, okay, yeah, we can expect a 14.5% return. Use that term loosely, but 14.5% from here. If we have a 14.5%, 2021, I don't think anybody would see that coming. It's entirely possible, of course, but yeah,
yep,
that would be a shocker, I think, to pretty much everybody on this call.
Yeah, and I think that's the dynamic that we're challenged with at BlackRock, right? Is you see all the cash on the sidelines, you see money pouring out of stock funds, right? Even index funds have negative outflows year to date. That never happens, and that's just such a bullish sign going forward. Whenever the herd is going one way, the market usually does well, but we're still not cheap from a valuation standpoint, right? We've had this amazing run since the lows of late March. Yet you still see all this money on the sidelines, all those dollars in money market funds. It just sets up, for a decent run for the stock market going forward, right? The question is, does it rotate out of, a handful of those big names? Does it rotate out of growth, right? That'll be the interesting next step. Or do you need another shakeout for that to really happen, right? Does international or emerging markets come back into play here a little bit? That's really, I think, but you've hit on something. I think it's fascinating right now. The dynamic of where the market's at, how much it's rebound, certainly not cheap, but you got all these dollars on the sidelines.
Mm-hmm. Mm-hmm. All right. So my next question was actually your next slide, the interest rate slide, or a few later. So, I mean, that paints or actually, I'm sorry, the one prior, the long-term trend. Yeah. Yep. So what I'd be curious about is how, I think I know the answer here, but how high yield fared in that time. I mean, high yield obviously is a pretty high correlation to the equity market. So I would guess that that's somewhere closer to U.S. stocks and above inflation. And then the follow-up question to that, I don't know if you know that answer, kind of where high yield fits in. And the follow-up question is, what income producing assets do you like in a rising interest rate environment? How do things like real estate do something that might have a little bit of an inflation hedge where it's kind of a hard asset, right? I mean, if we have a ton of inflation, the cost to build or replace some of these assets that could produce income is obviously going to increase. That impacts its price as well as its ability to cash flow. So just curious your thoughts there.
Yeah, no question. It's an easy answer on high yield on the left side because high yield wasn't around back in the 1940 to 1979 period. You don't have any high yield index that goes back beyond probably the early 1980s. So right. You really just didn't have a ton of asset classes on the left side, unfortunately. I mean, you're right. It would have been. You
did have, more junky kind of corporate debt or stuff that could be considered high yield, I would think, if you had the index. But
yeah, I'm sure you could probably look at there's probably a Morningstar category that goes back a little bit before 1980. But yeah, you're right. The assumption would be that it would have been, right, it probably would have been, 60, 70% of the return of stocks, right, 6 or 7%-ish in that environment. No question about it. And it's, did I forget the other part of the question? I'm sorry.
So the other part was, what income producing assets do you like in that environment?
Yeah, that's a great point. And I think something we talk a lot about here at BlackRock is that income portfolios are really challenged from, everybody talks about just the low level of income, right? And that everybody tries to gravitate towards some of these other income producing categories like real estate or convertibles, preferreds. all those categories have so much more risk today than they've had in the past, right? I just look at REITs, and these are traded REITs, of course, but those used to trade like boring dividend paying stocks, and today they look more like emerging market stocks from a volatility standpoint. So you really need to be careful in this income space, because you can always find higher income, right? There's always somebody with a behind door number 2 with a higher yield, right? But it's just the amount of downside risk that you're embracing. So you think about real estate, and you're right, it normally, traditionally is a good inflation hedge, but it's also very rate sensitive, right? So you're going to see if rates go up, that generally doesn't bode well for certain real estate, just because you don't get that cheap financing supporting it going forward. But it really depends on what the shape of that rate environment looks like, right? What does the yield curve look like front to back, right? So there's a lot of different dynamics there. Certainly, I think any hard asset, right, is going to look reasonably well in a higher inflation world. But, you know, I'm kind of an inflation geek, or at least I claim to be, which makes me a hit at the cocktail parties. This is not our parents' or grandparents' inflation number. So the inflation number on the left side that's showing 4.3 is different than the inflation number on the right. Just because they have made changes to the index over time, and we're just not going to see super high levels of inflation because of the way they've changed and evolved the index over time, for good reason in a lot of cases. But I think if you talk, you know, there's a lot of folks out there that say that maybe that headline inflation number doesn't truly reflect out-of-pocket costs for a lot of folks on a day-to-day basis. So that's a long-winded answer, but I think certainly some of those income categories will hold up well in a higher inflation world. You mentioned real estate. I'm just trying to think of some others that might do well in that world. You know, we always like getting it, you know, especially in a low return world, getting a good income stream is not such a bad thing, right? Just having that in hand is probably better than just relying on the stock market to go higher. But you need to really watch the risk in some of those income categories. Real estate being much more volatile than it's been in the past. Certainly, we've lived with the volatility with MLPs here the last couple of years, right? Just be careful in those income categories, how much downside risk you're embracing for that additional income. You know, I think our folks do a good job of that. If you look at our multi-asset income team or some of the models and portfolios they develop, they do a nice job balancing a good yield, but keeping a keen eye on downside and a decent return, right? You see too many other folks stretch for yield without worrying about downside, and it can be a horror show in that income space. Long-winded answer, but a lot there.
Yeah, for sure. And then my last question, you said you're an inflation geek, so tell me what you think about inflation now. I mean, literally everything that most households own, the biggest ticket items they own, is more expensive now than it was on January 1st of 2020. Houses are more expensive across the board, and more so luxury homes from what I'm seeing. But houses are more expensive. Yep. Cars are more expensive. The used car market is outrageous. I know there's some supply chain issues there, but I have friends who are builders, and lumber and supplies are up 200%. Again, supply chain issues, but nevertheless, they tell me, people who've been in the business for a long time, they tell me they've never seen, you know, Cape Cod lumber reduce their prices. It's all, you know, once they go up and people pay it, they stay there. You know, things in the grocery store are more expensive. I mean, like literally everything is more expensive. Even new cars, you know, they're not, you know, the sticker price isn't maybe necessarily that much higher than it was in 2019, but they're not selling with the same rebates that they were in 2019. So in some ways, you know, I know the indexes aren't showing it, but in some ways it almost feels like we just lived through a crazy period of inflation, but nothing's really showing that yet. And it would almost make sense because, you know, the stock market is worth more. As soon as your house is worth, I mean, people are more wealthy than they were, you know, even 2 years ago. Well,
right. Some of that's just a function of lower interest rates, right? Think about, you know, how low mortgage rates are now, and everybody can afford a little bit more home, right? Based on what they might have paid for financing years ago, right? And even not that long ago, probably what, year or two ago. Think about how much rates have come down. So clearly that's driven prices, right? I think, you know, any asset, right, the prices have gone up because interest rates have fallen. And certainly that creates a little bit of a disconnect in society as well, right? It's really, a lot of it's based purely on interest rates. You know, stocks have gone up in value, real estate goes up in value, and rates go lower. really supported by the central bank buying. But as far as inflation goes, you really want me to come back with my 40-slide filibuster on inflation, I think. But, you're right on. I think you look at what's gone up in price this year, it's a little bit of a mixed bag, right? Not everything's gone up in price. You actually see education. I think folks feel guilty about teaching online. So education this year is actually pretty flat for the first time in ever. But yeah, you see other places like, a great example is housing prices. Housing prices don't show up in the inflation index. They made that change in 1983, which would be the difference between some of the difference between the left and the right side of this inflation number, is that in 1983, they went from looking at having housing prices in the inflation index to actually using what they call homeowners equivalent rent, which is basically they ask you what you'd rent your house for. But if you look at the disconnect between housing prices and that homeowners equivalent rent, it looks like two different data series, because rents are amazingly stable. If anybody's got any rental properties, you probably know this to be true, is that it's hard to move rents in a dramatic way, either way, without something drastic going on. You even saw that during the financial crisis. Rents never went negative over that stretch, even though housing prices were a big negative. And the same on the way up as well. You just can't raise rents fast enough to keep up with higher housing prices. So that's completely taken all that housing price volatility out of the inflation index after 1983. And then you also see technology items. There's a lot of items in the index now that get quality enhancements. So if you look at televisions, for example, think about, I don't know what you paid for your last television, but think about the fact that you probably, out-of-pocket costs, you probably didn't pay less than you did 20 years ago, right? That's probably similar, or at least ballpark similar. But if you look in the inflation index, they have television prices dropping over 95% over that 20-year period, because they're accounting for the quality difference between the televisions. So you can see that's had a very disinflationary impact on the index over time. It's just capturing all these technology changes over the years, even though our out-of-pocket costs maybe the same, maybe they're even a little bit lower, but they're probably not 98% lower, if you know what I'm saying. So you have that dynamic occurring in the inflation basket as well, is that quality enhancement. But now you're getting me going on my inflation soapbox, so I better get off and let you guys back to the non-inflationary world that we live in.
Well, that's all I had. So if anybody else wants to chime in, thank you.
I have a question, Mark.
Any other questions?
Great presentation, by the way. So, back to the election and the unknown results in 2 weeks. What's your thoughts if it's a contested election?
Yeah, no, I think that's certainly a concern. I think it's likely that we won't know exactly on Wednesday morning. I think even with the polls seeming to trend a little bit towards Biden, I think it's still going to be pretty darn close at the end of the day, right, coming down to a handful of states. So I think it's likely that we don't know for sure. We threw out that data point on 2000 just to show that we do have a little bit of precedent there. I think it's really tough to see what that contested period would look like. I don't see it being tremendously disruptive unless, for whatever reason, we get some bad economic and virus news on top of that, right? If for whatever reason there's some unrest and it really starts to spill over into the economic outlook. Because whenever we look back historically and you see sustained periods of volatility, right, like back in the financial crisis or even what we had in March, it's really about that economic uncertainty that drives volatility in the stock market, right? You could have some events that might cause some volatility for a day or two or even a week or two, but for any sustained period of time, it's really got to spill over into economic uncertainty. So, you could probably think about the contested election and how it might cause that economic uncertainty. It's just, right, at this point, it's hard for us to exactly see how that lasts for any extended period without some other factors like, right, the virus or more shutdowns in place and Right. That just doesn't seem likely in a contested election period, but not out of the question given it's 2020 and all. So.
Thank you.
Well, if there's no other questions, we can let Mark go back to work. We good? Anyone else? All right.
All right. Thanks,
awesome.
everybody.
Thank you, Mark.
Yeah, appreciate all the time and all the questions. Let us know any other way we can help you.
Thanks so much.
Thanks, Mark.
Thank you.
Thank
Take care.
you.
Thank you.
So, Cammie, I saw in your chat you said you're going to get everyone the slides when you send out the newsletter this week.
That's correct.
Fantastic.
Yeah.
And now I know who they are, but there's a couple new faces here, and I wonder if they would like to unmute and say hello and introduce themselves. Holly and Julia specifically. What do you think, ladies? Welcome.
Hi, how are you?
Good. Go ahead, Holly. Go first.
Okay, I started working with Haas Financial Group about almost 2 months now. So I moved back home with my parents. So I'm really enjoying it. A lot to learn still, but it's a work in progress. So I'm just really excited.
Fantastic.
Hi everyone, I'm Julia. I'm going to be David Frisch's new internal partner at BlackRock. I'm taking over for Caroline Gannon, so I'm excited to get to work with all of you, and Frisch wishes he could have been here today, but he unfortunately had another meeting.
All right. And Tim, there's no new face there, but you got a new person in your family, huh?
Yep,
Tim's
last
a
night.
grandpa today.
Yeah, I had a great granddaughter.
Nice.
Congratulations.
Congrats.
Great.
Yeah, they're both doing well.
Fantastic.
Yeah, all the more reason to move to Florida now.
Well, there you go. And then she'll get restationed somewhere.
Yeah, she'll probably be back in the Middle East for as soon as we get there.
Ask her to request Pearl Harbor.
Well, that actually Hickam is one of the bases she's looking for.
Where's that?
Hickam is Honolulu.
Air Force Base.
Yeah, the other one is Lackland down outside of San Antonio. So both would be nice. Dad would approve.
That's good. All right. Anything else, Cammie, before we sign off? And
I don't have anything.
all right. Well, I'm good here on this end as well.
All right, thank you,
Thanks for
Kimmy.
joining us, everybody.
All right. We'll see you
Have a
guys
great
later.
week.
Thank you. Bye-bye.
Thank you.
Thank
Bye.
you.
Yeah, like you too.